My name is Steve Gribben, and thank you for joining me in this Glassbox strategy session. Today I want to talk about an often underappreciated metric in the small cap space, what's known as stock float. As you probably already know, a company's stock float encompasses all of its issued shares, less those shares taken back into treasury, less any restricted shares held by insiders, which can be officers, directors, or affiliate shareholders. Basically, you can think of a public company's float as all of its unrestricted shares that could readily change hands in the public market at any given moment. Now, a company's ability to understand, control, and leverage its float can have a tremendous impact on its growth trajectory. In fact, a small cap issuer's approach to managing its float can have a direct correlation to its ability to raise capital. Here's an example. If a company ties up all of its existing investors in restricted shares or issues too few shares early on, relatively speaking, it will be hard for a market to develop in that company's stock, and as a result, it will be hard for future investors to have any sort of confidence that they will be able to get out of their position when the time comes. Now, conversely, if the same company's float becomes too large, it may be hard for that company to maintain the share price it needs to qualify for an uplisting when the time comes. Managing the float is a balancing act. Here are some key factors you will likely want to consider as you are managing your float. Factor number one, nobody likes a float that's a tiny fraction of a company's market cap. Not regulators, not clearing firms, not investors. If your float is too small relative to your market cap, market participants are likely to draw two conclusions. Your stock could easily become completely illiquid at any given time. And number two, your stock could easily be manipulated by pump and dump artists. So a tiny float, relatively speaking, is likely going to weaken your negotiating leverage with potential investors. Now, factor number two to consider. Your float will have a direct correlation on your ability to raise capital at market prices. If you have a limited float, you will likely be constrained when it comes to raising capital by selling registered shares with any sort of variable pricing mechanism. ATMs, equity lines of credit, standby equity commitment agreements, they will all be impacted by having a limited float. Now, factor number three you want to consider when managing your float. A limited float can actually have a regulatory impact. If an investor sells more than 20% of the float in a 30-day period, their brokerage is likely going to have to file what's called a Suspicious Activity Report, or SAR, with FinCEN, detailing the investor's trading activity and, of course, the name of the company with which the investor invested. This is not a good thing. Once you have too many SARs naming your company filed by a particular brokerage, that brokerage will likely stop accepting your stock altogether, which could, of course, damage the overall liquidity in the market for your stock. Finally, factor number four to consider when managing your float. It's best to have a diverse group of shareholders that make up your float. If your float is controlled by just a handful of people, you will obviously be at risk of a rout in your share price if all these people decide to sell at the same time. For example, it can be particularly dangerous if you start off raising capital from a pool of 5 or 6 convertible debt investors that end up collectively making up 50 to 60% of your float, as these type of investors are likely going to want to sell based on the same triggering events. So bottom line, you need to have a healthy float in your stock before you can raise capital on favorable terms from all but the most fundamental investors. But at the same time, you have to be disciplined and strategic in how you build your float. Obviously, you don't want to issue shares just for the sake of building float. You want to find early stage investors that are more fundamentally driven, or perhaps investors that are willing to invest under a reverse convertible model, where you, as the issuer, can control convertibility. If you are seeking guidance on how to manage your float and would like to discuss financing structures that are best suited for your particular circumstances, I'd love to connect. You can reach out to us by completing one of our online inquiry forms at glassboxlaw.com or by sending us an email at info@glassboxlaw.com. Thank you.